Roku is an interesting company I've been following for several years, and investors are asking me to update my recommendation for Roku stock. So in this video, I'll review the latest developments at the company according to what management said about their recent quarterly performance. I'll share with you my fair value calculation, which I updated today, which reveals what I believe this stock to be worth, and you can compare that with the current market price to determine if the stock is undervalued according to my calculations. And then I'll update the recommendation whether I think it's a buy, hold, or a sell right now. I'll do all that in this relatively short video, so let's jump right into it after a brief message from my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so Roku's CEO said that their strategy is to grow their platform revenue. It's working. They set their platform revenue growth strategy in place 18 months ago, and they focused on execution and demonstrating progress along the way. So if you don't already know, Roku reports their results on two areas, two segments, their platform segment and their player segment. Basically, the player segment are the devices that get people into the Roku ecosystem. Those are the players that connect to your TV. But also more recently, Roku's been manufacturing their own televisions, and that can be considered as part of their player segment, which is the device that brings you into the Roku ecosystem. And then the platform segment is everything you do while you're in the Roku ecosystem, using the Roku operating system to watch content, to purchase content, to subscribe to streaming services. All of that, the platform segment is very high margin business for Roku. And then the player segment, the devices segment, those are low margin, even negative margin business. But Roku's okay with that because that brings you into their ecosystem. Then they generate years and years of profits off of your activity while you're in the ecosystem, which is very, very high margin. So the management team saying, then in the second quarter, they grew their platform revenue 18% year over year. Video advertising grew faster than the overall digital ad markets did in the United States, and this reflects their ongoing work to expand and diversify their demand. Roku has been growing their revenue faster than the digital advertising industry, which means Roku's gaining market share. They're already the number one TV operating system in the United States, in Canada, and in Mexico. The operating system works really well. I've used Roku's operating system, and I've also used the operating system of LG and others, and they don't work nearly as well as the Roku operating system. When I go out to look for a TV, I'm always looking for TVs that come with the Roku operating system because I like the way it works. It works more effectively than other operating systems for televisions I've tried so far. By the way, this document I'm reading from is Roku's Q2 2025 earnings call transcript. I've made this document available for my channel members, and you can join my channel for less than $5 a month. I have dozens and dozens of these highlighted earnings call transcripts available, as well as other benefits you receive as part of a channel membership. See the link in the description for everything you get for joining our channel. So Roku expects 2026 operating expense growth rate and platform margin to stay relatively in line with 2025. And the good news is that they're on track to be operating income positive in the fourth quarter of this year and for the full year in 2026. And the management team noting that the fourth quarter operating profit would be earlier than what they said even last quarter. So their profit expectations are turning out better than what management thought, and that's precisely what I like to hear from a company when they make forecasts for when they think they're going to reach profitability, or when they expect a certain product to launch, or when they expect to reach a certain scale. I like for those factors to come in better than expected. This isn't related to when a company gives you quarterly revenue and profit guidance. Those I like when the company is accurate and doesn't continuously exceed those expectations. But with longer term forecasts, I like when the company exceeds those expectations. There's a distinction that I talk more about in several of my videos. So if you're more interested in that, keep watching my content and you'll get a lot more clarification on that factor. So I wanted to share with you my updated fair value calculation for Roku, which I just updated today. And I calculated the intrinsic value per share at 106 compared to the current market price of 95. When I apply a margin of safety, this stock looks slightly undervalued, ever so slightly undervalued when I account for a 5 to 10% margin of safety. And given that this stock has a beta of 2.05, remember, the higher the beta, the larger the margin of safety I like to apply to my intrinsic value calculations. So this margin of safety would be on the higher end of the 5 to 10% I generally apply. So that's why I say it's ever so slightly undervalued when I apply the margin of safety. So I have had this stock rated as a buy all year long. And after reviewing the latest results and updating my valuation for the company, I still like the business. I like the long-term prospects. I like the tailwinds of the industry, the operating system, the competitive advantages, all of which is working in Roku's favor. So I updated my buy recommendation for Roku stock on September 10th, 2025. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.